I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. This video details the process for calculating your Social Security primary insurance amount, which is the basis for the retirement benefits you're eligible to receive on your own Social Security record. This is going to be one of the more technical videos you'll see here, but given the complexity of the primary insurance amount calculation, there really isn't a way to do justice to explaining it without getting kind of technical, so stick with me. But first, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. Before digging into the calculation, it helps to understand some background of what the primary insurance amount is. It's the monthly amount of Social Security retirement benefits you'll receive if you start taking your benefits at your full retirement age. As further detailed in my other Social Security videos, if you start your benefits before your full retirement age, your monthly benefit will be less than your primary insurance amount. And if you start your benefits after your full retirement age, your monthly benefit will be more than your primary insurance amount. The term full retirement age has no meaning or significance outside of the Social Security world. It doesn't mean the age you actually stop working or otherwise consider yourself retired. The concept of full retirement age exists solely for determining your Social Security benefits. Your full retirement age is 66 if you were born between 1943 and 1954. It's 67 if you were born in 1960 or later. And if you were born in the years between 1954 and 1960, your full retirement age is scaled in 2-month increments for each year you were born after 1954. For example, if you were born in 1955, your full retirement age is 66 and 2 months. If you were born in 1956, it's 66 and 4 months. And regardless of your full retirement age, when you retire or when you start taking Social Security, your official primary insurance amount is first calculated in the year you turn 62. But it gets recalculated each year after that. So if you keep working past 62, your primary insurance amount may increase from your additional years of wages. I'll explain more about that toward the end of this video. The first step in calculating your primary insurance amount is to compile your lifetime earnings history. To do this, you need to know your Social Security earnings for every year you've worked. It's important to note that Social Security earnings are not necessarily the same as your regular earnings. This is because you only pay Social Security payroll taxes on a certain amount of your earnings each year. That earnings cap is called the contribution and benefit base, and it adjusts each year based on changes in the National Average Wage Index. For 2020, for example, the contribution and benefit base is $137,700. Let's assume you earn $200,000 in 2020. You'll only have to pay Social Security payroll taxes on the first $137,700, not the additional $62,300. So, when calculating your primary insurance amount and looking back at your earnings in 2020, you would only include $137,700, not $200,000, because your Social Security earnings only include amounts up to that year's contribution and benefit base. Now, you can manually piece together your entire multi-decade earnings history by finding your Social Security wages as reported in box 3 of every W-2 you've ever received. Or you can simply take your earnings history straight from your Social Security statement, where everything's already neatly packaged in one clean table. If you haven't already done so, I highly recommend creating a My Social Security account at www.ssa.gov/myaccount. Once logged in, you'll be able to see and download your entire earnings history. You'll not only see the gross wages you earned each year, but more importantly, you'll also see the amount of each year's Social Security earnings, which is ultimately what's needed for your primary insurance amount calculation. Now, once you have your full Social Security earnings history ready, the second step is to index each year's earnings. Indexing adjusts previous year's earnings for wage inflation. For example, assume you made $11,700 in 1980. Well, that may have been a lot of money at the time, but not so much today because there has since been a lot of inflation. Indexing adjusts that $11,700 to the equivalent of what it would have been if you instead earned it more recently. All your years of Social Security earnings prior to the year you turn 60 get indexed by what's called an indexing factor. The indexing factors are calculated by taking the National Average Wage Index for the year you turn 60 and dividing it by the National Average Wage Index for each respective year of earnings. Let's walk through that. Assume you were born in 1958. that means 2020 is the year in which your official primary insurance amount is first calculated, because that's the year you turn 62. All your years of Social Security earnings prior to 2018, which is the year you turn 60, need to be indexed to 2018. To index your earnings from 1980, for example, you would take the National Average Wage Index for 2018, which was $52,145.80, and divide it by the National Average Wage Index for 1980, which was $12,513.46. That indexing factor would be 4.1672. Now multiply your 1980 Social Security earnings of $11,700 by the indexing factor, and you get your indexed 1980 earnings of $48,756. Do the same indexing process for every year's earnings up through 2018. Earnings in the year you turn 60 and all years thereafter are not indexed. For purposes of calculating your primary insurance amount, Social Security earnings in those years are taken at their face value, again up to that year's respective contribution and benefit base. Now that you have your full history of indexed earnings, the third step in calculating your primary insurance amount is to add together your 35 highest years of indexed earnings. Let's assume in our example that your most recent 35 years were your highest, and the total of those is $1,826,666. After identifying and adding together your highest 35 years of indexed earnings, the fourth step is to calculate your AMI, or average indexed monthly earnings. Simply take the sum of your highest 35 years of indexed earnings and divide that by 420. That's your AMI. The idea here is pretty straightforward. The $1,826,666 in our example represents your total indexed earnings earned over your 35 highest years. And since there are 12 months in a year, 35 years has 420 months. So dividing the 35-year total by 420 makes it a monthly number. In our case, $1,826,666 divided by 420 equals an AMI of $4,349. Now that you know your AMI, you can do the fifth and final step in calculating your primary insurance amount. This part is a bit clunky, but we're almost at the finish line, so stay with me. For purposes of this step, your AMI gets broken down into 3 portions, and each portion is multiplied by a different percentage. The dollar amounts at one portion, where one portion stops and the next portion starts, are called bend points. Like many other parts of the primary insurance amount calculation, bend points change each year. The bend points used in the calculation of your primary insurance amount are based on the year you turn 62. Sticking with our example of you turning 62 in 2020, your first bend point is $960 and your second bend point is $5,785. To finally arrive at your primary insurance amount, you have to take 90% of the portion of your AMI that is up to and including your first bend point. Next, take 32% of the portion of your AMI that is greater than your first bend point and up to and including your second bend point. And finally, take 15% of the portion of your AMI that is greater than your second bend point. Add together those 3 numbers and that's your primary insurance amount. Simple, right? Let's see this in action. In our case, you would take 90% of the first $960 of your AMI as $960 as your first bend point. That would be 90% of 960, which is $864. Next, take 32% of the portion of your AMI that is above your first bend point of $960 and up to your second bend point of $5,785. Since your AMI is $4,349, this means there's $3,389 that is above your first bend point of $960. So 32% of $3,389 is $1,084. And since your AMI is less than your second bend point of $5,785, you don't have any portion of your AMI that will get multiplied by 15%. So your primary insurance amount would be the sum of $864 and $1,084, which equals $1,948. As you can see, calculating your primary insurance amount is quite technical and cumbersome. Thankfully, the Social Security Administration does it all for you, so you don't have to. And even if you're under age 62, they calculate estimates so you can see what your anticipated primary insurance amount will be. You can find that on your online Social Security statement. So, if the Social Security Administration does all the work in figuring out your primary insurance amount for you, what's the point in knowing the calculation? Well, it's helpful to know what goes into it so you can know the impacts of certain employment decisions, like working longer, or economic changes like inflation, how they may impact your primary insurance amount. Here's an example. Even though your primary insurance amount is first officially calculated in the year you turn 62, it gets recalculated every year thereafter. So if you're in your mid-60s and deciding whether to continue to work to try to increase your Social Security benefits, you now know that your benefit is based on your highest 35 years of indexed earnings. So if you're only working part-time, for example, and not making much money, you now know that your additional years of work may not impact your benefit because they may not be in your highest 35 years. On the other hand, maybe you left the workforce while you were in the middle of your career and only have, let's say, 30 years of earnings. That means your 35 highest years will unfortunately include 5 years of zero earnings. If you can work a few more years to replace some of those zeros with the non-zeros, you'll be able to increase your primary insurance amount. And it's important to know that once you're 62, your primary insurance amount can go up, but it will never go down. As I just mentioned, it can go up from adding years of higher earnings to your earnings history, but it won't go down even if you stop working completely at that point. Well, that's a wrap for how to calculate your Social Security primary insurance amount. I know it was very heavy with formulas and technical matters, but I hope you nonetheless found it informative. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, join my free Facebook group, Taxes and Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.